Hello and welcome back to the Note. Well, we have a lot of drama on world markets to report today, and we also have a meeting of the Federal Reserve's FOMC, but very surprisingly, those two things have almost nothing to do with each other. Now let's start in Europe. European stocks had one of their worst days of the year. The FTSE Eurofirst 300 was down 2.24%. The main reason for that appears to be disappointing earnings, combined with the recovery in the euro, which is bad news as far as the earnings that exporters can expect to make. Then you also saw very impressive rises in bond yields across the continent. In the case of German 5-year bonds, their yield is now barely even negative. The main reason for this is that people are now much less concerned about Greece. There is a sense that we're not going to have a Grexit after all. That alleviates the risk, means that there is less need to pour money into safe haven investments such as bonds. Over here in the US, the big news came from GDP data for the first quarter. That was expected to be rough given the bad winter in the US and the port strike during the first quarter, but it was very much worse than almost anybody had expected, growth of only 0.2% for the first quarter. Now, how is that going to affect the decisions of the Federal Reserve? Well, we know from the statement they subsequently made that they acknowledged that economic growth slowed during the first quarter, and they said this was partly due to transitory factors. Plainly, we need to know exactly how much it was due to those transitory factors. The only other significant change you could divine in their statement this time compared to their last meeting is that they're no longer prepared to promise outright that they will not be raising rates at the next meeting. You could therefore argue that they have left the door open to raise rates as early as June. There are 2 more unemployment reports between now and then. I have to say I think that's extremely unlikely. We need better proof than we'll be getting over the next 2 months that this really was an aberration in the first quarter before they can raise rates that soon. It remains obvious from the statement that the Fed would like to raise rates if it can. Now, given that weak economic data, it's perhaps not surprising that the dollar on a trade-weighted basis is now its weakest in 2 months, and as for the euro, it broke through $1.10 for the first time in a while and then immediately went on to $1.11. All of these are completely logical reactions, and all of them happened before the Fed had even pronounced. We are left perhaps where we started. The Fed, given the data has not been as good as had been hoped, is plainly less likely to be hiking early than it seemed to be a few weeks ago, and therefore the dollar has started quite a dramatic correction. The question now is to wait for the next round of data to see whether that correction has been overdone or whether we need to see the dollar weaken still further.